What is up everybody, welcome back to another stock market video, and today I'm going to be going over my entire Sharesies portfolio. There's over 10 companies in there, so I'm just going to give a quick overview over each one. So my Sharesies portfolio is less than 10% of my total investment money, so therefore I just treat my Sharesies account as a short to mid-term and swing trade account. So the main reason I have this account is really because it helps me to learn about the stock market. I like to buy into these companies, hold them, and really start to understand them, even though it's only a small amount of money. And with Sharesies, it allows you to buy fractional shares, therefore it's a lot cheaper. So this is only one of my 3 trading accounts. The other one is Hatch Invest and Invest Now, and all of these are all based in New Zealand. So I don't want to go over the Sharesies fee structure, so what I'll do is I'll just add a link in the description of the fee structure and you can give that a read. But really what I use Sharesies for is any trade below 300 New Zealand dollars and lower. It is a really good way to dollar cost average into buying new investments in companies because the fee structure suits it quite well. Now each platform has a pros and cons to what they have, but make sure that you look into them and see what benefits you most. And most of these stocks that I currently hold, I've done previous videos, so feel free to have a look at those older videos. So just very quickly, if you appreciate that I share my portfolio, please give the video a like as it helps the channel out massively. And if you're into investing, feel free to subscribe. With that said, let's get on with the video. Moving to the computer, we are in the Sharesies portfolio. This summary is just a basic calculation and also why I'm not a fan of the way this is done. Personally, it's misleading, so I actually use an Excel spreadsheet which does a total amount of deposited money versus how much shares are worth if I was to withdraw them, including the fees. For me, it is a more realistic way to measure of how I'm doing. So have a look at my portfolio total right now. It's at 2,620 and this will change in the short term, and I've had a current return of 27.7%. I opened my account in April but didn't put serious money until August, which was money from the index funds. The reason I did this was because the index funds were only giving a low return in this bull market, so I took them out. At the end of August, I had just under $800. Then I put in the index fund money and brought it up to 3,300. All this, by the way, is NZ dollars. As it reached its peak, I sold out to secure profits, which was part of the plan to make money with Tesla, and I'll explain that further on in the video. Also note that some stocks are really low values because I have either bought them low or sold some shares. Again, remember, I'm new to investing in the stock market and some stocks are bought to learn. I think it's justified as I've taken out 2,000 New Zealand dollars profit from this account this year. So the first stock on the list is A2 Milk, ticker symbol ATM, and this is my worst performing stock in the portfolio, in which I mentioned in the August stock video. A2 Milk has dropped significantly because of a reduced guidance. That's management saying that they don't expect to make the forecasted target. Factors include COVID and getting product to China. Now I don't really follow A2 Milk closely, so when it dropped, when I lost 25%, I have plans in place to sell about 25% of the total holdings. As it keeps dropping, I sell more. This is because it's not a stock I follow, so I have these rules set in place. I also saw another opportunity for another stock, which was Palantir at the time, to make better use of that money. This is just my current plan to deal with losses for the stocks that I don't follow closely. As I've said before, to be a better investor, even though on stocks you don't follow closely, you need to make sure you have a buy and hold price. And more importantly, you need to have a sell price when things turn bad. So over this time, even though I've sold, I think now the price is quite good that I've started to buy small amounts of chunks. However, fundamentally and financially, the company is still strong and I see them just having to wait this out before they start going back up again. So the second stock in my portfolio is Facebook, and I've only got $55 in them and they're currently down by just under 2%. Ticker symbol FB, and the main reason why I bought Facebook is because they're a large cap US company and this was just to stabilize the portfolio. Facebook hasn't really done too much since I've bought them. It's been down by 2% currently, and it's just a tiny amount, but not looking to add at this stage. Still a great company with one of the best balance sheets around the world, and they continue to innovate, like the recent release of their Facebook marketplace, which I use in day-to-day life. So my third and fourth stocks is Fletcher Buildings, which is ticker symbol FBU, and also Steel and Tube, ticker symbol STU, and I'm going to group these two stocks up because I bought them for the same reason. I was testing the New Zealand economy bounce back from the March crash and government announcing that they would invest in New Zealand infrastructure, and we can see Fletcher and STU have done really well. Also, if you look at both of these graphs, both of these stocks are turnaround plays, where the share price has been declining and now they started to go back up. I was specifically looking for stocks like this, and how I found these stocks was from announcements from the NZX website for changes in management that could turn the company around. Also, the March crash helped these beaten down stocks, so I was sure with changes it was a matter of time before there was gains to be had. With that said, I'll still just be holding on to these to learn. And if you're wondering how to find these, I'll put a link in the description, but basically it's as simple as going into Google, typing in NZX Announcements, coming down here to the second link, and if you click that, it has market announcements and it shows you the companies and the different announcements that are available. So my problem with these two companies is that I don't really follow them closely. So once I saw the announcements, I basically bought the stock knowing they'd go back up. And the reason why they're a lower value now in my portfolio is I actually sold them off after, again, they went over 50%. So I'm just going to keep holding them and leaving them in there just as a learning tool to see how far they'll go up. The next company on the list is Microsoft, ticker symbol MSFT. And I've got $80 in Microsoft and they're currently up just under 7%. Again, another big cap company to stabilize the portfolio. Hasn't done much and traded sideways since owning. Not a lot of movement in the share price, some news around acquisition of TikTok, but not much else. Looking at Simply Wall Street, we can see from the summary that they're trading at 3.9% below our estimated fair value, and earnings are forecasted to grow 10.5% per year. Earnings grew by 15.5% over the past year. Moving forward, it's just another hold for me at this stage because at current prices, it's not a buying opportunity. Next are two of my NZ Healthcare stocks, Oceania, ticker symbol OCA, and Ryman Healthcare, which is ticker symbol RYM. Oceania has made some great gains of 59% and I've trimmed my position. Just again, my general plan when it goes over 50% as I don't follow it closely. And I'm not too worried about selling early because it's not a lot of money on the table. Ryman Healthcare is a very good company with great profit margins. They're one of New Zealand's biggest companies, so growing their share price is pretty slow going, but they're very stable. I've spoken to someone which actually works for Ryman Healthcare and they are saying very good things about how the company is run, so it gives me a lot of confidence in the management team. Over time, I'll just keep adding small bits of money in it, but as you can see, Ryman Healthcare is just over 14% return so far. The next stock is STOR Capital, ticker symbol STOR. Believe it or not, I actually bought the stock as a dividend stock. If you've seen my other videos, I dislike dividend stocks because I am after growth and making as much gains as I possibly can. I think that dividend stocks are for later on when you have big enough capital or a bigger portfolio to be able to live off dividends, although the passive income is very nice. However, for the sake of growing my investment knowledge, I need to figure out how to pick dividend stocks, which I have here with STOR Capital. Now I've only got 2 shares in them, but they're nicely up at 27.5%. Once again, STOR Capital is one of my previous videos. So during the March crash, STOR Capital was hit very hard, but as you can see from the share price action, they're very stable companies. So once this passes, I think we've got a very good discount on the price right now, and they'll continue to head back to their all-time highs. So Teledoc is a new position in the Sharesies portfolio, and you can see that I've just bought at $38, and also they're currently down at 3.7%. Just looking at some of the stats, you can see that their 5-year low was at $9.50, and their 5-year high was $249.40. So since the last 5 years, they're up almost 1,000%. And here you could have had them on December 2018 for as low as $45. I first learned about Teledoc is from the numerous YouTube videos that everyone's been doing about them and how good that their potential is going to be. So from this article here, Telemedicine Marketing Report Coverage, we can see in 2019 that the market size is $45.5 billion US, but the projection in 2026 is going to be valued at $175 billion US. So this is about an increase of 3 to 4 in the next 5 years, which is quite significant. And moving to another article, reading, from a service provider perspective, Ping a Good Doctor was the global leader in telemedicine services marketing, accounting for 40.1% of the overall market in 2019. This is followed by Teladoc and Amwell, accounting for 31% and 11.6% of the global telemedicine services marketing, respectively. So from this, we can already figure out that all Teladoc has to do is keep their market share, and basically they're going to grow their revenues by 3 or 4 in the next 5 years. I think this is the way the world is heading, virtual doctor appointments as an initial diagnosis so you can get immediate information about your condition. No more having to go to the doctor in person and maybe waiting numerous hours just to be seen. I will look to buy in the dips, and currently ARK Invest have been buying this daily in their funds, so that's always a good sign. So if you're wondering why I'm excited about Tesla being up by 63% and I've only got $64 in them, and that's because this was actually a swing trade. I hold Tesla in my Hatch account as long term, but in my Sharesies portfolio portfolio, I bought 5 shares to swing trade. It was pretty obvious to me that even though they went up so fast after the March crash, being accepted into the S&P 500 was always going to happen, as at the time they were like the 7th largest US company to be trading. My initial purchase for these 5 shares were around about $400, and you can see me buying fractional shares all the way through. And just after the 14th of November, you can see the inclusion in the S&P 500. And at the highest points, I sold some shares at close to $700. So this is why I explained earlier on that you can still see the gains even though I've sold these shares already, which I'm not too happy about, but that's just the way the interface is. Like all things, this was a gamble, but I made some very good money over the 4 months, which has made this Christmas very stress-free financially. Whoops, totally forgetting about the last stock that I've been buying in dollar costing average is Palantir, ticker symbol PLTR, and I've got 51 shares and they're currently up by 9%. So I've done previous videos on this, so all I'm going to say is that I've been dollar cost averaging into Palantir as I see them growing in the near future. So in total, that's 11 companies that I own in that portfolio, and no doubt over time those companies will change. Let me know in the comments if you have any stocks that you're looking into coming into 2021 that might have some good potential gains. Just before I finish off, this might be the last video that I get to edit for 2020. So I just want to wish everyone a happy new year and all the best for 2021 as we get away from a crazy 2020. And with that said, thank you for watching. As always, safe investing, and make sure you do your own due diligence for the stocks that you buy. You don't want to be listening to a guy like me who's just new into the stock market. So make sure you look into the stocks that you buy. May the gains be with you, and I'll see you in the next video. Goodbye.